Okay, Chapter 15, we'll take the next step in discussing the financing question. In this case, we're going to build on Modigliani and Miller's last discussion about a world with perfect capital markets, primarily discussing what would you do in a world that had no taxes. So let's think about the interest tax deduction. Of course, corporations pay taxes on their profits after interest is deducted, so it's tax deductible. And that certainly creates an incentive for corporations to want to borrow money. So let's look at this example. We have Macy's has $2.5 billion in earnings before interest and taxes. They have interest expense of about $430 million, and their marginal corporate tax rate was 35%. So let's think about what happens to their net income, right? They have ABIT's $2.5 billion. If they had no leverage, then there would be no interest expense, and in the end there would be net income of $16.25. But since they have this interest expense, their actual net income is less. $13.45 is what their actual net income is. So let's think about how that all pans out, right? I mean, obviously it reduced the value of the company's equity, but the total amount to all investors was actually higher. Without leverage, $16.25 went to the equity holders, but with leverage, $430 goes to the debt holders, and $13.45 goes to the equity holders, which then means that the total amount available to all investors is $1,775. So what we're talking about essentially is something called an interest tax shield. Right? It is the corporate tax rate times the interest payments. That is the shield. The benefit that the company gets is obviously the tax deduction. So in this case, we have $875 million. Subtract that the $725 million in differences in value, and it's $150 million is the shield. So if you took the 35%, the tax rate, multiplied it by the $430 million in debt, that's $150 million, and again, they're equal. So that is the actual value to the shareholders or to the investors. So the cash flow to investors with leverage is the cash flows without leverage plus the interest tax shield. So it's the $725 benefit without, and then plus the $150 is the actual tax shield should they borrow money. So we end up with a form that says basically the value of a levered company equals the value of an unlevered company plus the present value of the interest tax shield. So we want to talk about how do we ultimately come across this formula? How is it created? Well, let's take a step back first to the last chapter and talk about Modigliani and Miller's world with essentially no taxes. If you remember, he said that it really doesn't matter how a company changes its taxes, whether they are an all-equity company or a no-equity company. The changing of the debt structure will have no impact on the value of the firm. So it doesn't matter how much they borrow or whether they change or don't change. The value of the company will not change. So now we want to move forward and let's think about how that will now impact when we have a world with taxes. So here we have a company that borrows some debt, right? If they're going to make this debt permanent, right, then they're marginal, and they have a marginal tax rate, obviously is T sub C. In the end, the tax shield, the present value of the tax shield is a perpetuity because it's permanent, lasts forever. So the actual present value of the tax shield algebraically simplifies down to TC, the corporate tax rate, times the amount of debt the company has. So now we have a formula for the present value of that interest tax shield. So how does that affect the cost of capital? Well, here is our weighted average cost of capital. We have the cost of debt. Here is the weight of equity or debt multiplied by the after-tax cost of debt. And we can algebraically expand that. So now we have a pre-tax weighted average cost of capital. And then we have to subtract, again, this is the weighted cost of the tax shield. So there's a reduction ultimately that comes from the tax shield. So the weighted average cost of capital will decrease as we increase the amount of debt for the company. Out of here and come back. Okay. And here we are. Sorry about that. So now we look at the graph that we've seen in a previous example. Here was the pre-tax weighted average cost of capital. This is the cost of capital we had with Modigliani and Miller. Again, you see it doesn't change. In this formula, we have a declining amount of cost of capital when we increase the amount of debt. So if we plug that into a formula, if we assume that the cash flows are fixed or fairly consistent, free cash flow doesn't change, the only way to increase price then is to decrease the weighted average cost of capital, and that's exactly what this picture illustrates, is the cost going down. So now if we transpose that to a formula, we can see that for every dollar that the company borrows, as the debt level increases, the value of the stock should go up. So let's work through a couple little problems to see if we can maybe pull this together in a little bit more coherent thought. What's the pre-tax weighted average cost of capital for this Western Lumber Company? Here's the weights of debt and the weight of equity. Here we have the cost of equity and the cost of debt. So the pre-tax cost of debt is 8.67%. When you calculate the value of that, the $4.25 is the free cash flow. Take the difference between the risk-free rate and the weighted average cost of capital. This corporation is worth $91 million. If you calculate the weighted average cost of capital after tax, the only thing we have to do is adjust the tax cost. Multiply it times 1 minus the tax rate. So now the weighted average cost of capital is 7.97%. When you plug that into the formula, now we have the weighted or the value of a levered company. That's $107 million. So the difference between the two, $107 million minus the $91 million, means that the value of the tax shield to this company is $16 million. So we show that the value of the company actually increased when the company borrowed some money. So let's think about how companies might use this. Recapitalization just refers to changing the capital structure. Well, there's a couple of ways we can do that. In this first way, let's think about this. The company wants to try to boost its stock price. It has 20 million shares outstanding. Market price is $15. And it has had a fairly consistent, stable earnings, pays about 35% tax rate. They plan to borrow $100 million on a permanent basis and use that borrowed money to buy back some stocks. So, without leverage, the value of this unlevered company, 20 million times the $15 per share, is $300 million. If they borrow $100 million, right, and it's permanent debt, then the tax shield is going to be $35 million. So then the total value of this levered company should be $335 million. So how do we plug that all together then? Well, again, if you think about the value of the debt now as $100 million, the value of the equity is then only $235 million. Here was that last formula, 300 plus 335. So the total value of the levered company minus the debt tells you how much is left in equity. So in this case, we do see what? That the equity did go down. So it seems like we're complicating this issue. We're not thinking about how it's affecting price. But we need to put some more pieces together in this puzzle, if you will. Even though the price went down to 235, shareholders still get $100 million. So they still received the entire $335 million. So actually they got the $35 million over the value of their shares without leverage. So they received this gain. It's just that the piece that's left is smaller than the piece is now smaller because some of the equity is no longer shareholders. So how can we maybe put this together? Again, let's say it repurchases its share at the current price. So it's going to have to buy back 6.67 million shares. So it had 20 million, now it's going to have 13.3 million. So they have fewer shares, but they also have less value. So what has happened to the value of the shares that are left? So the total value of equity, 235 million. Now we have 13.3 million shares. So the new stock price will be $17.63. The old price was $15. So now these shareholders got to keep the extra. The ones that kept their shares gained $2.63 on their per share on their wealth. So the total gain to shareholders, again, is that $35 million. 2.625 shares, dollars per share times the 13.3 million. That's the 35 million we were talking about. Now this creates a bit of a problem, right? The shareholders who are selling their stock realize, or should realize, that the shareholders that remain are going to be better off. So the question is, how can the company get shareholders to participate in this program? And it's not necessarily the easiest thing to do. We may have to offer them a little bit more than the market price for them to sell. Again, thinking though, we could probably go up to almost $17.63 before we would destroy any new value that would come to the shareholders. So we do have some wiggle room with pricing. But in the meantime, while we're doing this, maybe we can just go to the market and try to buy back stock at the $15 per share. The shareholders don't necessarily know who is buying their shares from them. Now this is a great deal number of shares, so it might be hard to keep this secret for long, but we might be able to do a fair amount of damage to the shares that we're buying back before we might have to offer a higher price to get to our total of $20 million. So that's the first part of this chapter. It's a fairly simple chapter. It relies on the concept or the idea that there is value in being able to deduct things from income. You're saving on taxes. If you're not paying the taxes, that means that the owners, the investors in the company, are reaping that reward.